is good. Kindly click on the subscribe button and click on the notification button if you want to be getting more of my updates here in VX Point Official. Thank you.
Traders use basically an arbitrary stop based on an arbitrary dollar value, but really the way professional traders do it is they use information that's generated from the market to hide behind in a way, right? That where support is or where resistance is or where a market is showing signs of exhaustion, right? Where no more traders aren't interested to trade anymore. So for those of you that are new to one of my presentations, just a brief background on myself. I've got over 20 years of institutional trading experience, right? I spent 8 years at JP Morgan Futures on the trading desk, right? Literally coming in at 5:45 in the morning until almost 5 o'clock in the evening. Prior to that, I was with Cargill, the big commodity trading firm in the U.S. I was also with Commerce Bank for almost 4 years. I was a licensed Eurex trader, right, where we traded, the Bund, Bobbles, Schatz against the U.S. 10 years, the 5 years, the 2 years, even the 30 years, as well as DAX and Euro stocks. Prior to that, I was with EDF Man, the big English commodity trading company, for a couple of years, and I started on the CME floor with Dean Witter right back in the early 90s. And the reason I talk about this is because I'm one of only a handful of former institutional traders who have mastered both trading order flow and teaching it to retail traders around the world, right? So thinking as an institutional trader can seem like a difficult process, but with a little focus and dedication, everyday retail traders can begin to think like an institutional trader simply by studying order flow. You can learn to identify buying and selling patterns that big institutional traders often leave behind in the market. So let's take a look at the exact steps you need to follow to start immediately taking advantage of that institutional order flow that's taking place in the market every day. If I had to break down sort of the percentage of institutional order flow in the market, it's, they all say, oh, algos, HFTs, algos, make up 80% of the market, but that's not really what drives the market, right? Those HFTs, the algos, they provide that liquidity. It's the institutional traders, the big traders, the other time frame traders, if you will, that are taking a big macro view, and they have the deep pockets to move the market, continue it in a direction. But before we jump in, just a brief disclaimer. I do want you to understand that, trading involves risk, and an investor, a trader can potentially lose all or more than initial investment. Risk capital is money that could be lost without jeopardizing your financial security. Only risk capital should be used for trading, and those with sufficient risk capital should consider trading, right? I mean, you got to understand that. Sometimes people think that, oh, I lost my job. I've got severance that's going to last for 3 months. I'm going to start trading. Well, you're putting yourself in a disadvantage if you do that, right? The markets are there. They will be there tomorrow and the next day. Take your time to learn to trade properly. So let's jump in. So when you look at a chart, really, what are you looking at, right? We all start at some point. We open up our computer, we see a chart and say, oh, yeah, would have been great if I could have bought down here and sold up here. But when you're looking at a chart, really all you're doing is just seeing what price did, right? Where price traded at. It's not really telling you anything else. It's not telling you about the conviction of buyers and sellers, what they're actually doing in the market. So once you actually start considering what's actually happening in the market, then you can understand how bars form, right? In the old days, right? We don't have trading pits anymore where people are, yelling and screaming. They're bidding and they're offering, right? They're trying to transact trades. They're trying to transfer risk from themselves to another trader or maybe take on risk. So basically, what you see on a chart is trading taking place. There's buying and selling. And if you're looking at your normal candlestick chart, you don't see the intensity of that trading. You can't see that, maybe there was on the move down that, even though there's selling, right, we're going down, that the selling is getting weaker. Then at the low, aggressive buyers are stepping in strongly, right? You don't see that on a normal bar chart, right? Because a normal bar chart basically treats all trades equal, right? All prices equal, meaning whether, if the market traded 40.96, when you're looking at your bar chart, it doesn't tell you how much transacted there. And that's important, right? If you've ever run a business, you know that, just simple, any business, right? A simple lemonade stand, simply selling something, right? You know that as if you get a lot of buyers, oh my gosh, I got to raise prices because I'm going to run out of everything. Then the buying decreases. Same thing. If you keep lowering your prices, you're going to attract more and more buyers coming in, but then eventually you're going to run out of supply. And that's how the markets operate. But on a normal bar chart, you're not really seeing that information, that volume that's going through. Because, at the end of the day, if you've ever, like I said, if you ever run a business, you just don't look at everything that you sold, right? You say, oh, this is great. At 40.96, I sold tractors. Well, you want to know how many tractors you sold, right? Or how many bicycles you sold at a price so you could accurately price your inventory. And the market is the same way. Now, maybe about 15, 20 years ago, some traders got together, they formed, they figured out a way to take that information from the exchange because the information is there. It's available for everybody. You don't have to pay extra to see the volume, right? That's there, especially now we're in a computer age that, everything is traded electronically. So every transaction that goes through is information. And what they did is these traders they developed what's called a footprint chart, right, which shows you the volume that's traded on the bid and the volume traded on the offer. And from that, you can extrapolate, whether there's aggressive buying or passive selling or just normal transactions going back and forth, right? Just people trading normally. Okay. And because again, not every price trades the same. Some prices have very little trades. Other prices have very heavy trades, right? And by trades, I mean volume, right? Volume is important to traders to understand because if you have areas of thin volume, meaning, the market didn't spend much time there because the market is moving fast and it didn't really have much um, buying and selling taking place, that means something to a trader. Now, in about, I think 2013, 2014, and then finally in 2015, I released a software called the Order Flows Trader software, which is a footprint chart like on steroids, basically. And what it does is it helps traders understand, see a lot better where there's market generated information as support or resistance coming into the market, right? Here's resistance coming in here. Here's support, right? You can see how the market was going up and it came right down to this support level from before. And as the market is trading, it's forming in real time a resistance area. Okay. Now, I'm throwing around these terms, but I just want to spend a little time explaining them first. Aggressive traders, passive traders. It's not just trading. There's two types of traders. There's aggressive traders and there's passive traders. What a aggressive trader is someone who pays the market price when they're buying or sells at the market price, as opposed to a passive trader, which is someone that's working a bid or working an offer. So think about it for a second. A market is, say, 5 bid at 6. You have people trying to buy 5s, people trying to sell 6s. That is the liquidity in the market right now. Someone is bidding 5, someone else is offering it at 6. They are the passive traders. Now, if they just sit there and don't move, their price up or down, market's not going to trade. It's just going to be 5, 6 all day. What you need for a trade to happen is an aggressive trader to come in, either somebody that was sitting on the bid at 5 or somebody coming into the market saying, oh, you know what? Hey, I think this market's going up. I'm going to buy the 6s, right? That would be the aggressive trader. Or say somebody coming in that's working an offer at 6, thinking, oh, you know what? I just got a call from somebody, they've got, they're looking to sell So I'm going to jump in front. I'm going to be aggressive. I'm going to sell the fives, right? That would be the aggressive trader, someone that crosses over that bid offer line. Now it's from the passive buyers and aggressive traders that you get more information. Okay. You're going to get a piece of information called delta. Okay. Delta, you can see on this chart here, is on the bottom. And basically it's the net difference in a bar between the aggressive buyers and the aggressive sellers. Okay. And why is that important? Well, generally, as a market is going down, you're going to have aggressive selling, right? If market's going up, you're going to have aggressive buying. So you're going to have positive delta on moves up, negative deltas on the move down. Now, there are going to be some instances where a market is moving down and you have positive delta, or market is moving up and you have, bars that are giving you negative delta, right? Which is sort of opposite of what you're expecting. But that really what that should do is get you asking, why is that delta positive on a move down? Well, often it's a sign of supply coming into the market. Supply that's coming in as a market is moving down is bearish information, right? And you could see that. So sometimes you're going to see a market moving down and you're going to see an aggressive buyer came, an aggressive buyer or buyers came in and were lifting the offer, trying to take it higher. But at the same time, even though you had those aggressive buyers, you had a strong passive seller there, somebody in there with supply. And if you know there's supply in the market, well, what's that going to do to the market? It's going to help move it lower. Just as if a market is going up, right? You see positive deltas, then once in a while you're going to see, a green candle as the market's going up with negative delta. And you're going to think, well, why is this market going up with negative delta? Well, it would be going up with negative delta when there's support coming into the market, right? If a market is moving up and more people are bidding as price gets higher, they're supporting that market on the move up. What do you think that means to the market? Well, it's probably going to go higher. Now, the next piece of information that's very useful for traders is what's called the point of control. Point of control is the price level in the bar that has the most traded volume on both the bid and the offer. And it's important because, it's sort of the balance area, if you will, of a bar. Are we trading above the volume or are we trading below the area of the most volume? And then when you start comparing it to previous bars, it'll give you information as well the direction of the market. And oftentimes in moves, the point of control will also act as support or resistance, right? On a move down, right here we have a point of control coming through here. And you can see this next bar trades right back up to it. The bar after trades back up to it. The bar 4 bars later trades back up to it. And again, the next bar. Then we're going down. Point of control. The next bar trades back to that level. Point of control. The next bar trades right to that level. The next bar, point of control, trades within 1 tick of that level. And you often see that on nice moves up and moves down. Point of control acting as support or resistance. The third major piece of order flow is imbalances, right? When aggressive buyers outnumber aggressive sellers by a certain percentage, usually 4-1. I use 4-1. Other people use 3-1. And it's going to tell you that you have strong selling, if it's aggressive selling in the bar, or strong buying, strong aggressive buying, people lifting the offer. Okay. And, there's certain patterns that you see in the order flow. Like here, you have 3 selling imbalances stacked on top of each other. You got another 3 here, right? You see how as this market is coming down, now it's telling you, up here that, hey, you got very strong selling, right? You got strong selling again down here. And the market just continues selling off, right? You can see more selling imbalances in here, just as on the move up, strong buying imbalances. And you could use these information, to confirm what you're already thinking in the market, right? If you're long here, okay, say you're long from earlier, right? This was the other day in S&Ps, right? All got all the way up to 30, 36 and a half or so. If you're long from, earlier around 25, right? And you see the market trading up and you're thinking, oh, happy days, right? Market's moving up nicely. Then it gets slammed right here in this bar. Just by looking at the imbalances taking place, you don't want to be long it. That's just your sign to get out. Don't be thinking, oh, this market could probably reverse and go back up, right? You're seeing wave after wave in this bar. So 1 minute chart, two waves of actually three. You don't have a stacked imbalance here, but you got two more imbalances. Wave one, wave two, wave three of aggressive selling. That's a sign to, that's a clear sign to get out of position rather than let it come all the way down here and stop you out. Right? You could cut your position a little bit earlier than letting the market come all the way down to your stop to stop you out at your full stop. And like I said earlier in this presentation, people say, oh, you got to let your winners run and cut your losers short. Well, how do you do that? How do you cut your losers short? That's the part that many traders struggle with, cutting their losers short, because they don't have a way to understand what's happening in the market. They just get long or get short, throw in their stop and take profit, and that's it, right? Let the market come to them. Either hit the take profit or hit the stop level. Well, saying, trading is a little bit more, I'll say advanced, but there's another step, right? It's called managing the trade. And if you're reading that there's strong aggressive selling coming into the market, why would you leave your stop at its original level? That's your sign to get out early. That's how professional traders, institutional traders, are able to manage risks by recognizing that conditions have changed in the market. Right? You need a way to understand conditions are changing in the market, right? For us, for myself, as a small intraday trader, I don't consider myself an institutional trader anymore. I just trade for myself. But as a retail trader, right, our tool is the order flow. Whereas, the big macro trader, he's watching macro events, right? He's not micromanaging it on a smaller chart, but, for intraday traders, retail traders that do trade, we could see what's happening in the market just by watching the order flow. So again, delta, point of control, imbalances are sort of the three cornerstones of order flow. Now, exploring the different order flow techniques and selecting, the best suited technique for your trading style. And, it's funny because a lot of people don't realize that there's many, many different ways to approach the markets. And, just to understand that, if you've ever read, I'm sure we've all read Market Wizards, right? I know a lot of people that got into trading because of the book Market Wizards. But when you read it, the first edition, I don't know what there was, 15 traders or something in there, they all have different ways of approaching the market. There's no one way that they're all doing it. They all have their own way. Okay. And sometimes I see people and it's like they someone will post something up on Twitter or Facebook. Oh yeah, this is the trade I took. Then people will bash them, say, oh, that's not how you're supposed to trade. Well, there's no one way to trade the market. Okay. And especially when it comes to order flow, it's so robust. There's so many different ways that you could use order flow. And the beauty of order flow is you don't have to use it in isolation by itself. You could take it and use it with your existing method of market analysis. So here, just really briefly, I'm going to talk about three easy order flow analysis techniques you can use: stopping volume, market exhaustion, and when a market is out of balance. So stopping volume, what do you think that means? It means stopping a move, right? A brick wall is going to stop a car, and it's the same sort of thing with stopping volume. This is 5 years yesterday, right? Market was going up, up, up. And then right here at the high, see 1,700 contracts trade on the offer, right? I know that, this market, I know 1,700 contracts is strong size, right? And it's coming in at an extreme, right? You can see the top of these other bars, right? Here's 561, 618, 187, 30, 300, 136, 226. Then the market stops up here, 1700. Can't go any higher. It even went bid there, but didn't trade on the offer. So I know that there's liquidity right up in here. I don't need to use a book map or a heat map to see that there's liquidity. I just use my eyes. Or I could just see the volume. It's heavier than normal. All right. And then market sort of goes sideways, comes back up to that level, trades 89 contracts the second time. So the first time trades 1700, and it's 1700 on a bar. The total volume is 3800. So almost half of the bar's volume transacted right up here at the top of the bar. Then more importantly, market comes off a little bit, goes sideways, comes back up and tests it. Second time, it only trades 89. So this time traders are sort of cued in on what's taking place up here, right? They're saying, there's still liquidity up here, right? And they're not interested because they know that I don't have enough firepower to get past it, and the market sells off. This is wheat, okay? Now wheat, obviously different volume constraints than say 5 years, which I just showed you. But here's a market, it's going down, 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 hits this area down here, 89 lots. All right, there's passive buyers down here bidding at this low for 89 contracts, right? Even for a second, it went offered there. They bought those areas, right? The 42. So I know I got heavy volume down here on the bottom. And the market starts ticking up and going back up, right? It's not rocket science in the sense that, you got to know calculus, algebra. It's just common sense, okay? Okay, well, I know that if we're running into strong bids down in the market, right? Not a price floor, but an area where people think the market is cheap and they're all just sitting there waiting for the market to come for them. They absorb all that selling, and then the market starts ticking up. That's the obvious trade is to the upside. It's not something that you guys, I got some strong buyers here. I'm going to get short. I'm going to sell into that. No. Why would you do that? You should be going with the direction of the market. This is your sign of what institutional traders, the big traders, are doing in the market, just as here. Right? You know that the big traders are selling it up here. Okay, and that's the information that you're only going to see by looking at the order flow. If you're looking at a normal candlestick chart, you're not going to pick that up at all because you're not looking at the volume. That's why I spend a lot of time harping on the importance of volume, is because volume does matter. Now, market exhaustion. Okay, think about it. If you ever gone out for a run or exercise, you get tired. Market's the same way, right? Moves stop because traders run out of energy, so to speak. In a way, they're exhausted, right? They've got no more buying that they could do. They've used up all their energy, which is their energy is buying or selling. And when you're looking at a normal bar chart, forget about finding market exhaustion because it's dependent on the volume. Now, this is 10 years, right? 10 years trade on the board of trade. They trade boatloads of volume. This is a 5-minute chart. And unless you know what you're looking at, you're not going to be able to tell where the exhaustion is coming in. And that's why having software to highlight that to you is going to be useful. Here, I see exhaustion came in, right? You got this big bar that came in on the number, right? Traded all the way down here. Big selling, get down here. 7 contracts. This bar traded 30,000 contracts, but only 7 lots trade on the low. That's not normal facilitation of trade. Traders are done. They don't want to sell anymore. They just sold 2,000. Then, a few traders say, okay, let's see if we could take it lower. They sell 7 only. Nobody's interested. The market snaps back up and then works its way back up higher. Hits this high up here. Next bar starts coming off. You get an exhaustion print here. 2 contracts trade. These zones are what we call exhaustion print zones. Okay. And if you know that there's exhaustion up here, again, we just rallied all the way up, right? Then the next bar comes up, opens, and we start trading higher. Okay, every bar here opened, traded higher, traded higher, traded higher, then finally hit this high. Then the next bar opens up, starts continuing, right? Here, open higher, went higher, traded higher. Okay, maybe this bar is going to do the same. It's going to start trading up and go higher. Well, it doesn't go any higher. And at the top of the bar, you got very thin volume. You got two contracts trade. It's a bar that trades 25,000 contracts and two contracts trade up here. What do you think the market is telling you? It's telling you traders are exhausted, right? They don't want to buy anymore. They've bought all they can buy. And once you know that traders have bought all they can buy, well, what's going to move the market higher? Nothing. Because the buyers are tired. The market is exhausted. People have been buying it. They've bought everything that they need. And then what happens? You see the market trade down. This is E-minis yesterday. Okay, this is, around the 9 o'clock, right? Going sideways, and it breaks down. Well, on this bar, again, sideways, 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 basically trading between 96 and 4100. Top of this bar, you get that exhaustion print. Okay, so instead of just opening up and trading back up and trading in the range that we had just been trading, you can see you have your sign here that there's exhaustion present. And if you have exhaustion present, in this case, this is bearish exhaustion because it's coming in at the top of the candle. What do you think the market's going to do? Is it going to go up? No, it's going to go down. The next bar sells off 10 points. Right, and then drops another, 5 points. Okay, so that's how you can take advantage of the information that's available to you. Again, this information is available to everybody, but you just need a way to format it in a way so you could use it in your analysis. Okay, crude oil. Market's going up, you got your exhaustion print. You hit your high up here, you got your exhaustion print. One contract trades. These are at the top of the bars, right? Market's going up. Everyone's excited. Well, we're going to go higher. We're going higher. We're not. And the market sells off. Okay. Now, there are traders out there that, if you like to use support and resistance levels, if you calculate your own, or you maybe get some from a service, you draw them on your chart, you use the order flow, right? If your level was somewhere up here, 77.50, okay, right? Support resistance is usually not just one price level, but say 77.50 to 60, and you trade back up into that area. You get maybe to the other side of it, and you see you just trade one lot. That's your sign to short the heck out of it, because you know that these buyers aren't interested anymore. You have that market exhaustion, right? And you should be looking for the market to sell off. That's how order flow is used by traders that have their own methods of trading, right? You could take this information, wrap it around the way you're trading, right? Now, out of balance markets, right? Humpty Dumpty sat on a wall till he fell off. And it's the same with the markets, right? Markets are in periods of balance and periods of out of balance. And it's that, if you think about it, the way balance is, it's not one level. It'll balance at, 3, and then it'll go out of balance, trade 4, 5, 6, 7, 8, 9, and then at 10 finds a new balance. It's that area of when it's moving from balance to balance that moves happen. That's where trends come in. And when you're looking at an order flow chart, right, having having a way to analyze when a market is moving in balance or out of balance is going to give you an advantage over other people that don't understand the mechanics of what's taking place in the market, right? And you can see as you're going up, you have buying imbalances taking place here, okay? But it's one thing, right? If you're looking at a footprint chart right here, you can see it. If you're experienced, have software that's going to highlight it to you, okay? Because what causes a market to move from balance to out of balance is imbalances, right? I know that's a lot of balance words, but it's hard to see sometimes when you're looking at a footprint chart, right? You can see 1, 2, 3 buying imbalances here, 1, 2 here, another 1, 2, then 3 up here. And then you get up to the high up here, right? Now, again, remember, you also had that exhaustion print here. But now you're starting to see selling imbalances come in, right? And again, having software, having a tool that's going to highlight to you these areas where there's buying imbalances, multiples, is going to give you an edge over people that aren't even looking at volume. They're just looking at a bar chart. Because, if you're looking at a bar chart and you see a chart like this is 10 Rain crude. If you're looking at a bar chart, you see the market come up here and it's going sideways, starts breaking down. Bar chart traders will be getting short on the breakdown. But if you're looking at the order flow, okay, what you have, right? Market's going up. You're seeing these green boxes around this bar, this bar, this bar. That's telling you there's multiple buying imbalances, more than 3 imbalances in a bar that are bullish on a green candle, or 3 or more selling imbalances. So what happened, right? We're going up. You're seeing the aggressive buying, right? You're seeing the buying imbalances. You get up to the high of this move. Now you have this sort of orange box around here, which is telling me there's aggressive selling taking place. Well, where's it taking place? At the high of the move. Then you could add in, there's that exhaustion print, that one contract, because this is the same chart as before. This is your sign. Okay, yeah, you know what? I could get short up in here around the 77.80, stop just above, 77.95, as opposed to letting the market, sort of go lower, come back up, go lower, lower, low, lower, high, and then finally start to break and you're getting short at 60. You could get in 20 ticks earlier by looking at the order flow. Right? There's a market, right? It's out of balance, right? You can just see how the ebb and flow of the markets are taking place. Markets coming down, goes sideways, starts going up, aggressive buying coming in, okay? Goes up a little bit more, aggressive selling coming in. 1, 2, 3 selling imbalances, right? Off the swing high before the market drops down quite nicely. Okay, so hopefully you're starting to understand these things. Here's Euro currency yesterday, right? Market is just sort of going sideways, starting to tick higher. And then it jumps, right? You got this bar, 1, 2, 3, 4 buying imbalances in this bar, right? That's why it's got this box around it. These other bars don't. Okay, you get long in here. What is that? 111.10. Sorry, 111 even. And it jumps all the way up to 25, 2 bars, 3 bars later. 50 ticks, right? These trades in half ticks. That's your sign of what's happening in the order flow. It doesn't get any clearer, okay? This market is imbalanced. Now it breaks out of balance. How? The aggressive buyers are coming into the market. That's your sign of a market that's about to break out of balance. Leave one balance area, this area that we were in balance before, to find a new balance area up here. All right, so the second thing I want to talk about is leveraging the power of order flow analysis to easily identify key trading areas. When I think about it, it sort of reminds me of, when with the satellites, sort of discovering these ancient ruins in the middle of the jungle, right? When you're looking at a footprint chart and the order flow, you could sometimes see these things that nobody else sees, right? Because you're looking at the market from sort of a different perspective than everybody else. Okay, this was yesterday in the S&Ps, right? Remember we had this big sell-off, 4,100 all the way down to 70s. Okay, made our high here, then we started coming off and went sideways. Then the rug got pulled out, and the market dropped. Well, okay, what's your sign? Because again, market, had the low to the high, pulled back, right? Buy the dip. He bought the dip; it just kept dipping. All right, people say, well, you got a 38% retracement. Be looking for the market to go shoot up. Well, it didn't. The market got pulled. The rug got pulled out, and it sold off another 25 points. And if you're looking at just the plain order flow, it might be hard for you to recognize, because again, there's a lot of information in here, that what was about to come right here, this move. is difficult, right? Because you can just see, right, the market is just going down and going sideways. What's the clues that market can potentially fall? And this is why having tools that help you analyze the order flow, not just present the order flow. All the trading software has now some form of order flow footprint chart. But all they do is just show you a chart like this. It's up to you. They leave you to figure out what all this means, right? But when you have a simple software that analyzes it for you, tells you, hey, you know what? There's market weakness here. There's market weakness here. And so you got market weakness that's bearish, right? That's why these zones are being drawn out. Well, if you know it's showing weakness in this area here, why would you even think of getting long? You'd be thinking of being short. And the beauty of it is you just hide behind that area of market weakness. You don't have to have a stop up here to prove you wrong. You'll be proven wrong, if you're wrong, fairly quickly here. 4103 as opposed to, 4110, right? That's how you keep your losses small, by understanding what's happening in the order flow when there's weakness. Because if there's weakness here and the market trades back through it, well, it's invalidated. The whole reason for being in that trade is invalidated, right? Being able to identify, this is crude oil, right? Market sold off, came back up. It's showing weakness here on this move back up. It's showing weakness, even though it's market's moving up nicely, rallies from 76.05 all the way up to 35. But on this move up, there's weakness. And if you have weakness on a move up, well, the next play is to the downside. Okay. Now this is a bullish sign of weakness. I don't know how to describe it, but here's a market that's more or less going sideways, dips down below sort of this range that we had, then pops back up. So you had some selling come in here, gets below the swing low here, but then the selling just dries up. And so if that selling dries up, if that selling pressure is removed from the market, what do you think is left in the market? Buying pressure. And the market has a nice rally off that buying pressure. So when you're thinking of market weakness, right, it would be in terms of selling pressure or buying pressure. The buying pressure is getting weak. The selling pressure is getting weak, right? That's why then it draws out this area here. This is where you place your stop. That's why we draw out these zones. This is MNQ. People always ask, what about NQ or MNQ? Okay, same concepts apply. Market has been going up, pulls back. But on this pullback, it gets weaker. And if you know this pullback is getting weaker, chances are it's not going to pull back anymore. It's going to go higher. And it just pops for another almost 30 points. Traders love to talk about how volume is important, and it is. But what's just as important is the type of volume, that aggressiveness of trading, or in the case I just showed you, decrease in directional aggressive trading, which is a sign that sentiment is changing, right? The weakness of this move down is taking place. Okay. So this is just one of the edges you're going to get with order flow. Now, the last part I want to talk about is learning to identify order flow setups and using that analysis to minimize your trading risk, right? Think of it like this. You're hiding behind a wall. That wall is order flow. That wall is the information generated from the market via the order flow. Now, trading is all about risk, right? I've talked about this numerous times so far. Let your winners run and cut your losses small. But how? Well, you use the order flow. Okay, so market weakness as a level, right? Here. Okay. If I know I got market weakness here, maybe if we come back up, it'll still show weakness there, because what happened? Market was going up. Buyers got tired. Market sold off. Okay. Sellers are getting tired down here. Market went back up. Same area. Sellers aren't interested in here. To where? An area where buyers lost interest. I mean, eventually it's going to break out like it did here. It's not going to just go sideways all day long. But you're starting to see how you can use these different pieces of information. Okay. But hopefully you can start to put it together. Okay, here you got your weakness, right? Market was trading down here, came down to the swing low, starts going up. Sellers are exhausted already at this low. Okay, so sellers are exhausted, market starts trading higher. Okay, buyers got exhausted here, pulled back a little bit, went back up, came back down, testing this area where you had the weakness earlier. Okay, you see got within one tick and then rallied furiously. Well, when you start putting it together, right, what I was talking about earlier, price exhaustion together with market weakness, right? You get your market weakness here. Market goes all the way up, comes back down, gets back to the area where you have the weakness earlier, and you also have price exhaustion, right? Market is tired. So if the market is tired as you're going down into an area of weakness, that's your cue, right? Back up the truck, get long. And where do you place your stop? Just behind the area of weakness or price exhaustion, right? You don't need to have such a wild, far off stop based on some arbitrary monetary level. It's just right here, right? You get long here, the next bar. So you're just risking basically, in this case, this is a 4 range chart. You're risking, 5, 6 ticks, if that. You see, you don't even get any drawdown. The market just immediately just runs in that direction. All right, here's E-minis. Okay, you got market weakness here, right? Market was sort of going sideways, tried to rally, can't go any higher. Market weakness. Next bar, price exhaustion. Next bar, you even got 1, 2, 3 selling bounce, right? You got that red, orange-ish box around it, but really, you got your weakness, you got your exhaustion print. This is just icing on the cake. Maybe you want to add another one for that quick move down. Pulled back up, back down again. Again, where are you going to hide? You're just going to hide behind the area of weakness or price exhaustion. So all this information is generated from the market and not just some derivation of price, right? Moving averages, all that stuff is derivation from price. It just takes into price and looks at it over the last 15 minutes, does some calculation and comes out with something. This is based off of what's actually trading in the market. Where are you going to hide? Right here, price exhaustion. Market weakness, price exhaustion. Out of balance, this bar. Right? You got the selling imbalance, selling imbalance, selling imbalance. Market just moves down nicely. No heat on the trade like this. 10 years, 1 minute chart. This time it's the opposite. You have, you got your swing high here, came off a little bit, making a run back up towards this high. Price exhaustion, market weakness, and a nice move down. Where's your stop? It's just right here on the other side of the market weakness and price exhaustion, right? You don't need to have some stop further off. Let the market tell you where to place your stop. Bonds, 1 minute chart. Again, we sort of poke down below, start coming back up, market weakness, market exhaustion, and it's off to the races. Okay, so just let the market tell you what's happening, because really, order flow gets you as close to the market as possible, right? In a sense, order flow is the market. It's nothing more than the information that's generated from the buying and the selling. So hopefully by now you can see how useful and the power of order flow, right? Because at the end of the day, right, it's about finding an edge, over other traders. How are you